Thanks for pressing play on this video. We're going to be covering how to reduce your tax liability with tax deferred accounts. This sounds like a lot, but we're going to break it down and it'll be relatively straightforward, hopefully after this video. So what you can see here, first off, is I've got a little bit of a tax schedule for a single taxpayer. In a separate video, we've covered kind of how our progressive tax rate works. So feel free and catch that for a little bit more of an explanation. We're not going to cover that in this video just for time purposes. Instead, we're going to get into some calculations. So the first thing, let's break down a couple of key terms here. So when I use the terminology of a tax liability, this is the amount of tax or amount of money rather that we would owe to the government, which of course is a derivative of our adjusted gross income, which is obviously our income less any sort of deductions, and then kind of using the tax schedule to compute how much we should owe in taxes. That's our tax liability. And then of course the tax deferred accounts are things like 401ks. And so what that means is the taxes that we would pay on them are deferred to a later date. So in this case, retirement. 401ks are a very common form of tax deferred accounts. We don't pay taxes on them initially, and instead the money is then taxed later on when we withdraw it from the account. And so there's a little bit of strategy behind whether or not to get taxed now, like in a Roth IRA, or defer taxes to later. That's outside of the scope of this video, but maybe something to research on your own if that is relevant to you. So let's first look at our tax liability. So in order for us, or in order for me to be able to convey to you the tax savings associated with making a deposit into a 401k, we need kind of a baseline. And that baseline is going to be what we would pay had we not contributed into a tax deferred account like a 401k. So for starters, let's go ahead and calculate our tax liability. Now, if you've watched the prior video, we've already kind of walked through this, but I'm going to do that just here relatively quickly. So let's first assume that we are obviously a single filer. So I'm going to abbreviate that as S, and we earn, let's say, $35,000 in adjusted gross income. So we know that in order to calculate our tax liability, we are taxed, or the percentage of income is taxed that falls within each of the bands. So in the first row, this income is taxed at 10%. So anything up to $9,875 is taxed at 10%. Everything in excess of that, but not to exceed $40,125, is taxed at 12%, so on and so forth. So we're only paying that percentage of taxes for income that falls into that range. So all we need to do is some basic multiplication in addition to figure out what our tax liability is. So for the first band, we know that we're going to be paying 10% of $9,875. So that is simply $987.50. Pretty easy there. Now the second one is a little bit more difficult because obviously it doesn't fall, we don't earn exactly $40,125. We earn a little bit less than that. So what we're going to do is we're going to take that $35,000 and we're going to subtract it from the top end of the prior row. So that's going to be $35,000, and we're going to take that number and we're going to subtract the $9,875. So go ahead and pause the video if you want. You can do that just to calculate it on your own and then come back to this video. All right, once you've done the calculations, what you should get is $25,125. So then what we're going to do is we're going to take that difference, and let me go ahead and make a note of that. So that's $25,125. So we're going to take that number and we're going to multiply it by 0.12, which is of course 12% in decimal form, and that's going to get us 3,115. So really altogether, our tax liability in this scenario is $4,002.50. Okay, now just for comparison purposes too, we're going to calculate our effective tax rate. So we're going to take that $4,002.50, we're going to divide it by the $34,000, and then converting it into percentage form, we're going to get 11.4%. So we are effectively paying 11.4% of our adjusted gross income in taxes. So now I'm going to show you a common tax reduction strategy or tax minimizing strategy, which is contributing to tax deferred accounts. And so this serves two purposes. One, it allows us to contribute money to something that will grow over time, like a retirement account, for example, which we can, of course, draw on when we're at retirement age. But it also has the secondary benefit of reducing our tax liability. So there are a couple of big benefits associated with investing into tax deferred accounts like 401ks or traditional IRAs. So how this is going to work is we are going to first determine how much we're going to contribute to our 401k. So I'm going to switch colors here. And let's say that we're going to contribute 6% of our income into a 401k. And we're just going to keep things really, really simple and assume that's 6% of our adjusted gross income. Chances are it's going to be 6% of your net income or your gross income, rather, that you get on your paychecks. But we want to get into those details. So we're going to say that 6% of our income. Now, 6% of $35,000 is $2,100. And this is going to go into our 401k. Now, an important note is obviously that is not going to go in at once. It's going to be over time. We're not necessarily calculating returns or anything, so it's not necessarily totally relevant. So first off, let's go ahead and calculate our tax liability. So the cool thing about contributing to tax deferred accounts is that decreases your adjusted gross income. So instead of adjusted gross income of $35,000, our adjusted gross income will actually go down to $32,900. So this is essentially what our adjusted gross income now is, because that $2,100 that we contribute to our 401k is tax deferred. Instead of taking taxes on it initially, we're going to pay taxes on it in the future. So now we need to update our tax liability because it's a little bit different. So now we're going to take our $32,900, which is our new AGI, and we're going to subtract that from $9,875, and that's actually going to get us $23,025. Multiplying that by 0.12 gets us $2,763. So we still have the same $987.50 from the first band because we're obviously moving into the 12% tax bracket. But now we only have $2,763 in that second band, which is going to give us a total tax liability of $3,750.50, or if we divide that by our adjusted gross income, 11.4% or so. So if you look at this, right, this $33,750, by contributing to our 401k, we have essentially reduced our tax liability by the difference of $402,050 and $3,750.50. So go ahead and pause the video and go ahead and work through the calculations on your own if you would like. Otherwise, we can go ahead and keep going. And so that difference is $252. So we've essentially saved ourselves $252 in taxes by making those contributions to our retirement. So the interesting thing is when we look at things and compare them sort of apples to apples, if you will, one of the common things is, well, if I'm, this $2,100, if I were to do this monthly, right, that would actually cost me $175 per month contributing towards my 401k. But if you really look at it, right, that $252 in savings is actually making it so that you're not contributing as much. So it's not going to impact your paycheck as much as you originally thought because you're getting that reduction in taxes. So really, $252 divided by 12 months is actually $21. So effectively, you're contributing 100 and or you're paying out of your paycheck $154 per month into retirement, but getting $175 if you factor in the tax deduction or the reduction in your tax liability. This isn't even including any sort of capital gains and share price appreciation or dividends that would result in you contributing towards some sort of financial asset that is going to grow in value and provide value for you over a long period of time. So again, I think most people agree that investments and 401ks and those things are really, really good. The problem that we think is that the gratification is so delayed, right? The benefit that I receive is so far off, but based upon these simple calculations, you can see that there actually is an immediate benefit to contributing towards our 401ks, and that is reducing our tax liability. So hopefully that was helpful if you're making a decision as to one, if you're taking a personal finance class. I'm sure you'll find this helpful for doing calculations and solving problems and that sort of thing. But from a personal finance standpoint, outside of something that's course related, right? Trying to make those decisions as to whether or not you're going to invest in your 401k. Perhaps this could be something that you use in order to make an accurate comparison, knowing that contributing towards an asset like that is going to provide you with an immediate benefit. Now, one thing I want to mention here is this primarily is viewed through the lens of a 401k where, it's employer sponsored, which means that they're going to take a deduction out of your income and that's going to be reflected on your paycheck. But what if you were contributing towards a traditional IRA where you are actually paid and then you contribute the money into an account later? It works very similar, but the difference would be is at the end of the year, you would get to claim those contributions as a deduction on your taxes. So procedurally, it looks a little bit different where technically you're not getting the benefit during the year. But when you file taxes, obviously that reduces your tax liability there. So in the end of the day, it works out the same. Procedurally, though, it's a little bit different. So hopefully that's helpful. If you have any questions, let me know. Otherwise, thank you for watching.